Well, good afternoon from London. We're here with an FS Club webinar entitled Why 2021 Will Be a Record Year for Mergers and Acquisitions in the Knowledge Economy, Consulting, Software, and Technology Services. And we have with us today two experts from Equitec, Paul Dondos, the Managing Director, and Phil Baxter, an Associate Director. And I think we're going to be learning some very interesting things about the state of the market that are somewhat counterintuitive given all the doom and gloom that we hear around us about COVID-19. Those of you who know me, I'm Michael Mainelli. I'm one of the directors of Zien, and it is a real privilege to be able to introduce these webinars because our sponsors allow us to range widely and freely across technology, economics, and finance. And today we're certainly going to be looking at technology and finance as we explore what is the knowledge economy, and what are some of the trends out there, mergers, acquisitions, and never forget, of course, divestment, people that also selling off portions of their businesses. So we'll have a lot of time to explore that. You'll know the format, many of you, is fairly standardized for most of these. I'm trying to get out of the way as quickly as possible so you can hear from our experts. Phil and Paul will be showing about a 20-minute presentation with a fair amount of good detail. And then we're going to move into the Q&A. So three obvious things. One, the slides are up and are in the chat room already and will be available afterwards. Two, the recording will go up in approximately 2 working days. So you should be able to share that with friends or colleagues who are interested. And finally, on the Q&A, I'm here with you. So please don't send me questions or comments via email, Signal, or WhatsApp or something. Please do use the GoToWebinar question facility, and I will feed those comments into the conversation with Paul and Phil. Paul and Phil will be receiving all of the comments and questions that you send through, so please send as many as you like, and your email will be attached to it so they can get back to you if you've got something of detail that you would like to pursue with them or chat about. So with that, I think there's no further ado. I'd like to hand the floor over to you, Paul.
Thanks very much, Michael. I'm Paul Dondos, Managing Director at Equitec. I run principally our market intelligence practice, which is about getting information from the markets, putting information back into the markets, and monetizing that in various ways. So we're going to start, if we can just move on to the first slide, just by talking about why we're actually running this webinar. What's the point? I find myself frequently describing Equitec as existing to solve a problem. And that problem relates to how you look at value in particular in knowledge economy firms. There's a lot of risk in valuing them. There's a lot of risk in owning them because they're based on people, they're based on IP, things that walk out of the door every day. And that presents certain challenges to different sides of that community. What we're doing today is we're reacting to some very significant events in the world's economy that we all know about and that have been described as doom and gloom, that place a certain perspective on what the coming year could be like. And we're going to guide you through how we think that impact has actually translated into trends that we can see being borne out this year too. So as I say, last year we saw the impact of COVID on markets, temporary paralysis, different direction that things moved in, disruption of supply chains, new technologies accelerating to cater for the new conditions, challenges around talent, demand for certain types of talent right across the economy, across the global economy. What we've seen, and we're gonna talk this through, is that disruption was actually very short term in terms of M&A in our sector. By the time we got to Q4 last year, the volumes were back up at near record levels. It's looking the same way in this quarter. Looks like it's going to be even with that or greater. And we can see that sustaining through the year, and there are reasons for this. I'm going to talk through them. It is also a challenging environment. Just because there's lots of M&A going on, or we expect lots of that, that doesn't solve anyone's problems. It's quite good if you're in investment banking, supposedly, but there's a lot of competition around for that, and it's all about getting the right outcomes for all the participants in these transactions. If you're a player in the market whether you are a seller, a buyer, an investor, or you are somebody who is operating commercially and is interested in how to navigate those current trends, that we will be addressing points of interest for you during this webinar. And I'd like to start us off then with a quick poll, just to get an understanding of which types of participants in this area of interest you are. So if you could please indicate whether you see yourself primarily as a buyer of assets, a seller of assets, an investor, or a participant that's unlikely to be involved directly in transactions but wants increased awareness of market conditions. Please.
Great, Paul. I've launched that poll. Over half the audience have voted, so I'm just going to leave it open for a few more seconds to get most of them in. And now closing that poll, and I'm going to share the results with you. There we go.
Okay.
So as you can see, the majority are participants who want to learn or are investors.
Right.
Great. And bringing the slides back now.
Great. Okay. Thanks very much, Michael. So just a quick word on Equitec. I think it's important to give more context around why we're delivering this message. When you think about investment banks, there are the bulge bracket banks on one side, the Goldmans, the Citis, the JP Morgans. Used to work at one of those. And you have in the middle, mid-tier firms that are large banks. There could be businesses with other, great, more generalist services, businesses that have an investment banking practice. And then you have the boutiques. And those boutiques make up for what they don't have in scope by having particular sector focus. They sometimes do this and miss out on elements that you get in a bulge bracket firm, like having full service in market intelligence, in research, in buy side, sell side, advisory that can be offered through those mid-tier banks as well. They're not global. They're very transactional. All of those things that we've tried to address in Equitec. So we're just focused on the knowledge economy. It's a very exciting area. It's an area that came from management consulting firms and developed and converged through IT services firms and media and marketing firms and engineering consulting firms. And all of those are constantly intermingling, changing and developing, becoming increasingly tech-enabled, increasingly have a software element and continue to develop very quickly. All of them are serving innovation. And during this period that we've just been through of the pandemic that is ongoing, that disruption is provoking nothing if not innovation. So it's a very exciting area. We are global. We are sector specialists. We are a bulge bracket boutique. We do have all those services. And we take a long-term view. We are consultants and advisors to companies over a long trajectory. This means we see the market from all of those angles, but just our market and see the context of it in the global economy. So in terms of the way that we saw the disruption last year, it was very short term. There's the figures in terms of M&A volumes on the left. You can see the dip in Q2 last year. In Q3, we were almost back up. And in Q4, we're up at record levels. Q1 is nearly there. There's additional data to come in, which could push that again above that level. So those are the facts. What happened to make that, to mitigate that disruption? We had changes to structures in deals, earnouts that recognized the impact of COVID last year and therefore baked that into the kinds of structures and values that were being placed at the heart of deals in M&A, so allowed those to go forward. There were COVID normalizations. It was understood that there was a temporary impact, and those were then placed as context for the valuation of companies. There was great demand for those, increased demand for those firms that could prove they'd been resilient through this difficult period. And there was a shortage and therefore rarity value of high quality assets in the market. Those businesses that did go to market fetched great outcomes because there were fewer of them. What we had coming at the end of the year and really now, it was a divergence between what was looking to be a global recession on one level. We had the knowledge economy overperforming above that, because the knowledge economy, the consulting businesses, the tech-enabled consulting businesses, software businesses were serving the disruption and being valued on that basis. And then you had on top of that, at an even higher level of performance, M&A among those companies, because they were in high demand, because there was more capital that was trying to chase them, because there was competition for the assets. So you had three different levels of performance there. It didn't seem to be related, but there was a logic to that continues. Next slide, please. So what do things look like from here? There's the demand is shown on the left, some quotes from PE-backed firms about chasing deals. There's intense competition for assets. This is meaning that private equity in particular finding that there's a strategy to invest in areas with that are less competitive, so perhaps smaller deals than they would be looking at typically, in order to build assets that they can then sell in more competitive, more valuable areas. So a lot of movement even between levels of value, and businesses moving into the knowledge economy, increasing as investment areas that would have been comfortable in other areas primarily. So increased capital, increased availability, increased interest in transaction. We run a survey. In the middle you can see one clip out of that. We run a survey annually on what buyers think about the market, what the prognosis is, and here you can see overwhelming opinion that 2021 would be a year of more M&A activity, and that checks with the quotes, many more we have from talking with the market all the time. And then on the right there, this diagram that describes some of the risks or the challenges that are faced both by sellers and buyers in this market, and the sellers have the challenge of standing out in a market where there is significant interest in selling, in capturing those high values that there are at the moment. So it's important to be differentiated in that. And buyers, therefore, challenged with all the capital that there is, all the competition that there is for assets, and all of the assets that are becoming actionable in choosing the right deals and winning them. So that's the challenge from two of the sides that's represented by what's a good market, supposedly a strong, a buoyant market, actually presents significant risks. Next slide, please. So before I hand over to Phil, who's going to talk a little about three of these underlying trends that we see accelerating through this period, I'll just run down some of the key trends here. So the adoption of digital is accelerating, hardly needs more comment and reference. Here we are on one of those digital platforms that probably was doing a lot less business before all of this happens, but it goes into every aspect of our lives. Emerging technologies are being commercialized rapidly. So around these technologies, we're seeing ecosystems, service ecosystems, and technology ecosystems growing up very, very quickly to position to leverage new technologies that are being developed. There is convergence across sector and delivery models of blending. Convergence has been around for decades between industries, between verticals. We're now starting to see increasingly convergence even between delivery models, business models. You're seeing service businesses increasingly working with software products as part of their actual business model, not just as accelerators, and those are getting created. Private equity participating increasingly in the knowledge economy. I mentioned this before. There is an overwhelming move to comfort among private equity in a playbook in the knowledge economy. They see more and more success stories in this. There's more familiarity with that, and there is increased funds available through capital that was not invested in the early stage of the pandemic as well. We have new technology platforms emerging. We have vertical software solutions playing an increasing role to differentiate against what was predominantly horizontal players previously. We see returns to nearshore locations for buyers as it's been possible to decommoditize a lot of work due to the pace of innovation that we're seeing. And the last point, shareholders aligning expectations and addressing structural risks. We find daily, if not multiple times daily, we're talking to shareholders that are thinking about a capital event, thinking about a transaction, certainly having either because they've been approached and or because they see the value of operating as part of a global platform, a multi-vertical platform, a multi-capability platform. So with that, I will hand over to Phil, and he can talk us through a few of these trends.
Paul, thank you. I'll just deep dive into 3 of those trends then. So starting with the digital adoption trend, which, as Paul said, is a long-standing trend, and it has accelerated quite greatly during COVID. I guess if you think about end markets, it's kind of hard to imagine any enterprise right now that doesn't have some sort of digital transformation program in place. And if you take that sort of overarching interest in digital transformation, you can imagine that that's creating unprecedented and unparalleled opportunities for the service providers that address those needs in the marketplace. Whether that be implementation partners, advisory partners, training, managed services, consulting, etc. And in turn, that's translating into substantial M&A demand for those service providers. You can see some of the stats on the slides. When we polled our buyer universe last year, we saw at least 2/3 of our audience who said that digital is the key driver, or one of the key drivers of M&A. And in fact, that's probably increasing even more. So I don't think a single conversation goes past without day-to-day in our business that doesn't touch on digital in some way. So let's just dive into that a little bit. So if you think about the technology side and then think about the advisory side, on the technology, there's interest all the way across the value chain, from public cloud providers such as AWS, Microsoft and Google, and on the enterprise technology platform side, sorry.
Seem to have an outage there. Paul, are you able to pick up here?
Yeah.
Oh, sorry, Phil's back.
Yeah.
Sorry, Phil, you want to pick up there?
Unmute, Phil.
Paul, why don't you?
Okay, I'll take us through these. So the seller priorities then, from our point of view. So digital transformation, as we'd seen it previously, we used to talk about it reaching the C-suite. At this point, it's gone beyond C-suite. It's gone on to the C-suite critical risks log, and that's something that happened immediately in Q2 last year if it hadn't happened before for businesses. So clearly driving significant interest in adoption, right, on at another rate. So this means that buyers have been increasingly competing for these kinds of assets, and that has increased the flow of funds that is going into innovating in those businesses as well, and solving clients' problems using technology has become more important so than actually having expertise within a specific technology stack. So it's about the solution rather than just merely having the capability. For buyers, there is interest that has peaked around those public cloud service providers. Again, one thing that was the kind of immediate instruction, I'd say, at board level through as businesses went into lockdown, into pandemic conditions, was how could the business be kept stable, and there was immediately any programs to move businesses into the cloud were accelerated. That was probably one of the primary spend areas in IT. That has meant that we're now in a situation of very high valuations around businesses that have any kind of public cloud services exposure. It's been prohibitive, and it's something that has meant that it's increasingly an area for financial sponsors to play in that strategics have struggled to be able to actually get purchasing. So this makes it very, very challenging. Businesses, buyers of businesses need to actually activate, in many cases, smaller assets that are off market in order to be able to build up sufficient capability in these areas, because the pricing of these, that once they go into process, is prohibitive. Let's move on to the next trend. Convergence across the sectors and delivery models blending, right? So I mentioned this. I think that convergence has been around for a long time. You can see from the diagram on the left, different areas of cross-pollination across the knowledge economy. So you've got tech services clearly blending with software, SaaS, tech services with management consulting, and with marketing communications, for example. So what this has only accelerated as businesses have become less fettered by being in physical environments, and this has also been something that has led to expectations of an increased recurring revenue component. So as private equity, as financial sponsors have seen that it's possible to get from areas of the economy recurring revenues where previously they were service project revenues, they've increased their input, financial input into these types of businesses. So this means that as a seller in these markets, if you have provision, if you have services around these different elements of consulting, it has become a priority to at least look at the possibility of expanding into service lines that have an increasing recurring revenue components. We've seen businesses go from being entirely project run into having strong maintenance managed service offerings. On the buyer side of this, again, there is interest, but primarily in those businesses that are able to generate, therefore, some kind of recurring revenue, and that is reducing risk for investors. And the other element there is the innovation, which businesses are actually buying in one area of their service offering to pollinate into other areas of the business. So we saw, earlier we saw the likes of Deloitte adding on Deloitte Digital and McKinsey and so on, Accenture Interactive. These actually germinated into the businesses to make cultural advance in the business, and other acquisitions of growth and innovation companies have led to development of dynamic capabilities within consulting firms that enable them to be more adaptable in the face of innovation. So, M&A is solving in this way the risk between, or the dichotomy between being top of the pile and being irrelevant, essentially. So that such is the pace of innovation that without making acquisitions, you can't organically develop in ways that are so different to your existing proposition capability to adapt to change and be agile in the market. Next one. So vertical software solutions. There was a time when the software sector was less mature, and it was possible to be extremely valuable as a horizontal solution. As those have developed, there's decreasing space available, let's call it, for emerging softwares to play across verticals, and that level of specialization that is associated with more tangible, visible outcomes that is therefore something that vertical software solutions and have it has become increasingly popular. So you can see it, to take an example with, let's say, Microsoft Dynamics, that working across small, medium enterprises, that the finance function was one thing, but what's now the IP in that particular product is being developed around working in one specific vertical. And you can see clusters, ecosystems of service businesses that have developed their IP software that's specific to a vertical, and that's valued much more highly than a lot of new enterprises that have more horizontal offering. So sellers, you need to have an infrastructure to be able to demonstrate to investors that you can develop long term in those niche areas. Management team's key, finance team's key within that, technology platforms as well. It's key to demonstrate that you have capability for corporate development, that there's an M&A function, for instance, or a track record of that in the business as well. From the buyer point of view, it's key to value businesses in terms of their end markets. They really need to have a very large addressable market to be able to accommodate the levels of growth that are now expected in those niche softwares. Okay. So just to sum up on the slides we've had. So in terms of the seller priorities, so we ran the poll at the beginning, and I think there are more participants here that are looking from an investor, or we could call it a layman's perspective, also in terms of not being owners of assets or buyers of assets, right, specifically in this market. But I think let's populate that perspective with what it looks like to the direct participants in that. So for a seller in the current environment, it's absolutely key to differentiate the market proposition, to make sure to reassess the market proposition in light of the fact that a lot of the competition will be playing this convergence trend to add to their business models, their delivery models, and that will be having an impact on value. Reassessing what the value of the business might be in this current environment may affect the attitude towards some kind of capital event, investment, ways that the business is capitalized. If you are going to market, it's going to be important to differentiate in this environment. A lot of businesses seeing the value opportunity. And here we talk about a crowded market today and a wait until 2022 crowd. We're less sure about the environment in 2022. We're pretty confident that the underlying trends are going to be prevalent through this year. But at some point there will be that moment at which it could be further risk. And from the buyer investor point of view, you need to be very clear about your origination strategy. There's a lot of capital chasing assets. It's not clear sometimes where the value lies in those assets. There are smart ways to play the markets. It's not about going in and buying one asset. It could be getting a platform and then building up through add-ons to that platform. So we're seeing different private equity, different strategics looking at markets that way, wanting to break into new geographies and seeing valuations being challenging, but actually finding let's start with a platform and then let's build around that in ways that were probably just financial sponsors working in that way previously. And you need to sharpen your buy side story. Buyers have to sell to sellers in this environment. There needs to be a clear path to get more value, usually with less risk. So that's some takeaways and open to questions.
Well, Paul, that was a commanding performance in a survey of a wide area. We've got quite a few people online, so folks, please do get your questions in early so we can address them. Paul, we just had a message back from Phil that sadly he won't be able to join us for the Q&A, a bit of technical issues back there as we saw. But to get kind of cracking into this, one of the things that I was sort of curious about was in your slide about the vertical trend, this trend towards vertical. And you mentioned that white spaces, horizontal white spaces, seem to be filling up. What was the last major horizontal white space you were thinking of?
I wouldn't say it's the last major horizontal. I think that this is happening across in different areas. And I think the example that springs to mind, which is quite recent, is where we've seen processes for Salesforce service businesses, right? That previously they ran out, and we found ourselves. We had a very successful process last year, and other processes were coming to the end of opportunity to achieve good outcomes with a generalist proposition. And I think that what's more fertile now is businesses that are really quite focused. I mean, that's been the case across different industries, across different areas of the market. But there was one that we saw. We felt like we got one of the last really substantial, in Europe certainly, good outcomes out of the Salesforce ecosystem on the services side, and where we saw other processes landing in more trouble than they'd expected to be, just because there'd been a saturation of those kinds of assets without significant specialization.
Okay. You mentioned here on this slide, closing the crowded 2021 market versus wait until 2022. Bob McDowell has a question on this. He's sort of saying, what impact will both a delayed return to a new normality or an accelerated return to a new normality have on the M&A business and the knowledge economy? Certainly, we're seeing a lot of contraindications that it will be back to normal very quickly because the vaccines are rolling out, versus people saying, no, we're really thinking about it. This could take quite some time.
Yeah, I mean, our opinion on that is that it's a great hedge. As I said previously, the knowledge economy exists to serve disruption. Right? It helps businesses to process disruption. There's going to be disruption to process, whether we go back to normality, and what the normality is or when it happens, it's going to be there. I think what's happened has created a stock, let's call it, of disruption that's going to outlast significantly whatever pace the return to whatever normal takes, right? I mean, I'm talking to, on one hand, there's digital technology services providers, but on the other hand, we're talking to construction management firms, project management firms that work in commercial property in the City of London, for example, to take some relevant example. And for them, there's one thing that makes a challenge for those businesses is that the cash dries up as the investors, the developers, or they reassess their options. In other areas of the knowledge economy, it's financial sponsors have to look at treating some of the firms in their portfolio that are not in great shape. They stop investing. That happens. But the underlying trend is to be able to change those facilities. So for the physical world, those project managers are going to get brought in over time to be able to adapt to a new environment. So there you consider the physical world, the digital world, wherever it is. If it's about what holds those businesses together is knowledge, expertise, and needing that around innovation. That's not going to. I don't think it's a strong trend, whatever the kind of very, very short term timings of that are. We saw in one quarter we were back up to pace in M&A now.
One of the things that the audience is interested in is geography. For example, where are the hot spots? And Hugh Purser's got a very specific question. Are most of the cross-sector transactions occurring within specific geographical markets?
Cross-sector being, let's say, for example, management consulting firms buying IT services firms, right? We mean that within the knowledge economy. Yeah, sure. I don't think there's a distinction there. I'd say in terms of, I think there's plenty of that going on in Europe, in Asia, in the Americas, right? What we do see differences in is around valuations right now. We're finding that the valuations in North America are higher for the same types of businesses, and we're finding that there isn't more or less demand for businesses for that convergence trend that we talked about. I think that's what you're addressing. I think that exists right across the world. We're even having, because there's other things as well. There's other elements to that as well, which we touched on. Just changes in delivery models as well. So you're finding businesses looking for resource in previously, offshore geographies, offshoring geographies, are becoming themselves areas for onshoring and direct capability. We're seeing businesses looking for assets in India that are not about offshoring at all. They're looking for strategy consulting assets in India to work with Indian clients and so on, for example. Right? So, if anything, these things are proliferating. They're leveling up. However, the only area that we really see a difference in is that there's a couple of terms of valuation sometimes that are being evident in the North American market versus the European.
Okay. Vladimir Dimitrov says, thank you for useful overview, but he's got some more practical needs. For example, I'm looking to acquire a fintech with at least 50,000 active customers in Portugal. Who do I turn to? What do I do?
Well, you can. This is a service we offer, and I'm sure other banks and consultants offer that. So to do that, what you need to do is, there are databases of these businesses, but the challenge is understanding where the real value is behind those capability descriptions, and that just takes not just a trained eye, but a lot of process. It also takes participation in the market. And so you need a banking element over that consulting element in order to be able to do that successfully. So drop us a line, or bear in mind that that's what banks exist to do, and just make sure that it's a specialist that you turn to in a particular sector, because it's not clear when a business portrays their attributes, their clients, their successes on a website, perhaps badly, what the real value is behind that, and actually to reach out to those businesses requires a certain degree of kind of gravitas in the market, and so that's important as well.
Some interest here. Obviously, when we look at other sectors, I take in particular utilities. They seem to have been, at least historically, quite inflation-proof. But how resilient is the knowledge economy sector in its models to inflationary pressures? And in that context, is inflation yet a factor of which you take account in your M&A transactions?
It hasn't really been a factor. It doesn't come into account because or rather, it's specific to it's situational. It will be specific to a company's asset base, client base, and you build that into the structure of a transaction, the expectations for earn-out. It's more of an integration question than a transaction question.
Okay. Your third trend was talking about the M&A convergence across the sectors and how the models are blending, and I found that very interesting, all the various intersections there. But does that imply that we're moving towards some kind of horizontal, sort of this is how you tackle an entire sector, and you do it with engineering and management consultancy and software services?
I think that's not so remote a possibility. Let's take one example, sustainability. So if you think about sustainability, used to be a department in the engineering consulting firm, right? Or it was a separate agency, maybe it was a creative agency, or it was an environmental agency that was unique and independent from anything engineering. What it's become now is you're seeing sustainability on both sides of supply and demand as well. You're having capital that's coming with sustainability written on it. You've got sustainability SPACs, you've got sustainability funds, and then you've got sustainability being baked in as a product into responsible supply chain in management consulting firms, and then within the environmental areas of engineering firms, but throughout their whole proposition. And then you're seeing it in communications firms that are CSR reporting firms. And so you start to see that building in every element there. It hasn't quite become a data proposition yet. But it means that Accenture could be as interested in sustainability as Jacobs. And if you see then Jacobs buying PA, you know, Phil's not here to comment, but certainly one of his favorite transactions. You have engineering companies buying management consulting firms at scale, global firms, and you can see that there's not really a limit to that. Now, does that become a horizontal knowledge economy player? Well, we're an example of that. We're playing across the horizontal, right? We've got one activity that runs right across all of those verticals, unified by the common theme that it is about people, expertise, IP, and how do you value those? How do you make those more valuable? How do you make those more sustainable? So I do think it's going that way.
Yeah, interesting. No, quite convincing. I remember the days when we had environmental consultancies, and they were these tiny little units that sort of put a splash of green onto what you were doing for some of the logistics and supply chain stuff, which is now baked in, as you say. You've mentioned value and valuations quite a bit. Obviously, that's the subject. You've also said that the valuations tend to be higher in North America. But Vladimir's curious, can you suggest typical multiples for valuations of mature, successful businesses? So leave startups out of the way, but in three areas: vertical software, market research agencies, and management consulting. Any kind of range on that?
Yeah. So what was the first one?
It was vertical software.
Vertical software companies. So software companies are typically going to have a revenue multiple, and depending on level of maturity scale, you know, you can be anything from 3, 4, 5 times revenue to 15, 20 times revenue on some, and including on some of the public companies. If you look at was it media and marketing services businesses, yeah, slightly lower than the management consulting businesses. You might find those at 6, 7, 8, 9 times EBITDA. Again, as they get larger, they can go into double figures if they've got strong growth equally. And there are things around having niche and niche expertise and having data in the proposition that will raise those. Same thing for management consulting firms, but generally a little bit higher. If you're in the US, it's if you're going at a good clip, you're expecting a double-digit EBITDA multiple at the moment, with the heat that's on the market, right? Once you've reached a reasonable scale, and by reasonable scale, we're talking about getting to the sort of $20 million top line, particularly in the US, where that kind of level is achieved sooner than in, say, Europe.
Very helpful. Got time for just two questions then. Bob, again, how much are the fee structure models changing, if at all, for banks and professional advisors in the current market?
That's a good question. Well, you never quite know, do you? Because you don't know what everyone else is doing. But I think, and this is a trend that makes sense as something that will continue. Right? Is that banks are expected, or service providers are expected, to get more skin in the game, right? In a particularly competitive market, there has to be an assurance around, confidence around the outcomes that you're going to provide. So it's not just banks, right? This is actually right across our sector that we cover. And so there is, there's likely to be a trend that pressure towards that. And that leads to sometimes higher risk reward profiles. So it's an interesting development. And again, a convergence of capital with service as well, which you can see happen.
And just a final question, how robust do you think the knowledge economy business models are currently? We've seen a huge change in the way that we're doing business, and the knowledge economy and finance and tech have found it, I would argue, easiest to adapt. But where do you see that going? Are these business models robust?
Yeah, so I think I've touched on kind of recurring revenue models versus project models, and I think that there is bound to be a tendency towards that to sustain the levels of productivity and profitability that have come through this, productivity at least, that have come through these new ways of working. I would imagine it's not by itself sustainable without an alteration in the business model to be more data driven, more recurring revenue driven. So there's more assurance, less risk in the business. Because at the moment, I think things are being driven to an extreme of performance of productivity. So I do think it's sustainable. I do think it's do have certainly confidence in the model and in the area of the economy. Success will depend for individual participants in that on the extent to which they're able to adapt to a lower risk model through some of the ways we've talked about.
Okay. Well, Paul, it's been great to have you on, and really good to get this snapshot at such an important time. Please extend our apologies to Phil for the technical issues that arose. And if you give me a minute, I'll have to close things down with 3 quick rounds of thanks. The first round goes, as ever, to our sponsors. Thank you for letting us range widely and freely, and I can suspect that some of you were watching this with great interest. Secondly, if I could, I would like to thank you, the audience, again for your participation. A reminder that we've always got a fairly full schedule, and the easiest thing is just to go to the website. But I would highlight Friday at noon, when we're going to have Lord Holmes, Chris Holmes, on with a very interesting proposition. What would the UK do with a digital services bill, sort of an analog to a financial services bill? So certainly you're going to be touching on cryptocurrencies and other things, but they're much wider issues to do with encryption and privacy. And he really wants FS Club's advice on what might need to be included. But if I may, Paul, not only did you come on to do your bit, but you wound up doing Phil's as well, for which we really appreciate it, and just shows the depth of preparedness you have. I'm unable in this new business model era to open the floodgates of applause easily, but I have brought with me my Korean karmic clapper, which I'm afraid I have to do for applause. And thanks so much to you and the team at Equitec for coming and explaining the state of the market. We hope it goes well for you.